Well, good morning or good afternoon, wherever you are coming from. Hello, Brenda. Afternoon, Kevin. Assuming you're all on the East Coast. Still having coffee out here on the left coast. It's only 9 o'clock. I've only been up for 5 minutes. Hey, Rowan, what's up? It's sunny though. It's not cloudy and rainy, dark and drizzly like usual. So, hello, Rena. Welcome out to Trading Coach's Playbook. Let's get the disclaimer part out of the way. That's really weird. That's irritating. Oh well, the background's not there. It's like it's supposed to be, but I am not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade for regulatory reasons. We do not discuss funded trading here. Hello, Helen. Good to see you all out here. Breathe. Hopefully, I won't be coughing up a storm. It's kind of hit and miss right now. That's part of the reason I'm having coffee too. Hopefully, to keep the coffee at bay. If not, I'll try to mute it beforehand. So, but here are all the events coming up. You got premium workshops, Inner Circle, February 9th and 19th, Mastermind Group the 10th and the 17th, Trade You the 11th and the 23rd, and Monster Market Movers. Is that right? The 11th? I thought it was the 12th. Maybe not. I don't know. I think I'm doing that one, but Monster Market Movers is on the 18th. The free workshops, Power Hour every Monday at noon. And then this one, Trading Coaches Playbook, is every Friday at noon Eastern time. And then you got Power Option Plays Monday and Thursday. Cover to Call Explore with Trip on Thursday. E-mini Think Tank with Brandon Monday, Wednesday, and Thursday. So if you want some more information, education, pick your poison and join us. Of course, we're on all the social media platforms as well. So find us there. I just noticed, George, you've got your hand up. I don't know if that's intentional or not. If you have a question or comment or anything, just drop it in the chat box. So, yeah, I'm not sure if that was inadvertent or if it's there for a reason. So, like I said, find the chat and drop your questions or comments in there, and I'll address them when it's convenient. And check everything. If we haven't met, that's me many years ago and lots of pounds ago. But these are the tools I've created over the years, Patterns in a Flash, which is all technical analysis and learning to not only the foundational charting, but how to recognize patterns. That's what the Flash part is for, flashcards, right? You all use flashcards as a kid, right? To memorize math. Took that same concept and applied it to chart patterns. So basically, you just flip through these, flashcards on the screen, and then you learn to recognize the patterns quickly. And then there's about 6 or 7 or 8 hours of video in there, all about charting, foundational. Each individual pattern I go through, what to look for, what to look out for, what makes it strong, what makes it weak, and potential entry points for that particular pattern. So, if you want to upgrade your technical analysis skills, that is a spectacular tool. I'm a little bit biased, but then again, there's been 1,000 or 2,000 people over the last decade or so that have used it. So, and only one complaint. Lady said I talk too fast. So I was like, "Are you crazy? I don't talk too fast," which I do. I know that. Which, crazy enough, actually, I slowed myself down doing those videos. So that tells you how fast I normally talk. But the Weekly Whispers is just a weekly. It's basically candidates I go find for my own trading because I go through my watch list once a week. I got a filter. Usually pulls about 300 to 400 stocks. I flip through that, look for patterns, and basically, excuse me, I basically just funnel it down, get 300 to 400 candidates, and find patterns that I recognize. Right, I'm just flipping through it about 1 second each, find the patterns, and then narrow it down. Basically, it's like a funnel, right? You take a big old group of things, and then you squeeze it down into a smaller thing, and you find basically the cream of the crop. Looking for the best of the best. And then I just take that and basically record my analysis, what I'm looking at, my trading plan. So every single week you have usually about 20 to 30 candidates is kind of where I land. Now, if it's below 20, that's pretty small, which doesn't happen very often. 2, 3, 4, 5 weeks a year maybe. And then over 30 is about the same as the other side. So most of the time it's 20 to 30 candidates. So every single week you'll have certain candidates that you can look at and you can see why I like them, what they look like, what the patterns are. So it's a great complement to patterns in a flash or vice versa. And then small accounts big returns is a class I did. I guess it's been a couple of years now, maybe even three. I don't know. It's just a pre-recorded 2 hour class about how to manage a small account versus, I mean, if you're starting with $1 million, right? They always tell you how to make $1 million in the market. Start with 10 million, right? The goal obviously is to grow, but a lot of people do that. It's easy to fall into that trap when you get started of you know, losing as you learn. And that's not shouldn't be unexpected. I mean, obviously the goal is to make money, but in any business, no matter what business you're in, and this is a business, if you treat it like a business, you'll get the results of a business. But most businesses you have to invest in, right? You put money up front, not only start the business, but you also make mistakes as you're learning the business. And uh, sometimes those mistakes are not very costly, and other times they're very costly in any business. Doesn't matter what you do. I remember my dad was a reforestation contractor, would be probably the politically correct term. He planted trees. Um, he's a forester by trade. That's what he got a degree in from Oregon State back in 1969, I think, 68, whatever. Um, but he moved out to Oregon, was working for, I think, Weyerhaeuser, and wanted to start his own business and knew trees and knew how to plant trees and had done it. And like, I can do that. So you'd go out to, somebody would log a couple hundred acres in summertime and they'd go back in the wintertime and, look at the ground and how hard it was. And he'd have to bid it out and basically put together a bunch of numbers and say, here's how much my cost will be. And here's how much I need to make a profit. And I remember him talking about, I wasn't deeply involved in the business, but I remember him talking about times where he'd lose money or, one of his guys didn't do something right because they'd go out and inspect and make sure they planted all the trees right. Otherwise, they're all going to die off and they have to redo it. So they'd always have somebody go out and inspect the work. And there was at least one or two occasions that I remember where they had to go back and replant a whole bunch of them the next year at his expense. So he ended up losing money on those jobs because, somebody made a mistake or somebody did something wrong along the way. Or I remember one time he misbid it. He thought it would take, 100 man hours and it took 200 man hours or whatever the numbers are. I don't remember what the specifics were. I don't think he got into the specifics, but um, it doesn't matter what business you're in. If you make a mistake, it's going to cost you money. And in trading, the hard part with trading is that we automatically think because that real world example that I just used, which you could apply to any business. You talk to any business owner, I'm sure there's many of you in here, you've all experienced that where something goes wrong and it costs you money. But that is in the real world, that's what we associate it with is doing something wrong. And that is something, we're going to be talking a lot about mindset today, a lot about psychology. That is something that we have to shed when it comes to trading. We have to get rid of that idea that just because we were wrong or something didn't work out or we lost money, we were, uh, if we lose money, doesn't mean we were wrong or made a mistake. And I find it easier to, and I use this analogy a lot, put it in the realm of sports. You look at baseball, especially, you look at batting, right? A baseball player doesn't go up and get all mad. He goes up and strikes out. He doesn't get all angry. And I mean, sometimes they do, right? They get angry and, depends on the game and the heightened emotion if it's the World Series. But um, they just go up and swing the bat. And they know that over time, as long as they are doing their thing, right? They've trained, they've done all this stuff to get to a point where they have this skill set. They know that they're going to strike out 30 or 40% of the time. They know that 70% of the time, 75% of the time, they're not going to get a hit. They're either going to walk, strike out, fly out. And that is more relatable to trading than traditional businesses. Because in trading, you're going to be wrong a lot. Because just like in baseball, right, you got this little 3-inch ball that's coming at you 80, 90, 100 miles an hour. You got a little bat that's about 3 inches in diameter as well. It weighs 30, 32 ounces. You have a split second to make a decision of whether or not it's worth swinging the bat and seeing if you can hit the ball. And then if you make that decision in a split second, then you have to swing the bat and you have to make contact. And on top of that, you have to get the ball into play. And on top of that, you got to make sure that the defender doesn't either catch it or get it in time to throw you out. It really is, when you step back and you look at how difficult that is, it's amazing they're hitting 25, 30% of the time. And that's, in my mind, I use that in my own mind to recognize that's essentially what trading is. It's extremely difficult. You've got a million pieces of information coming at you, a million things going on. You got a million things going through your head. And you've got to make a decision, not necessarily in a split second like that, but sometimes you do. It depends on your style of trading, what you're doing. But it's difficult. And the most difficult part about it is mindset. And, excuse me, the reality is those that make it to the bigs in baseball or any professional sport for that matter, the reason they are where they're at is not necessarily because of their skill set, it's because of their mindset. It's because they handle the failures and the rejection and the losses in a healthy way. And trading is really no different. You've got to develop that skill where you are mentally and emotionally in the right spot. That's the only way you're going to get there. Okay. Only way. Because skill only goes so far. You can be the best. I remember thinking that when I started back in 2000. It's like, man, if I can get good enough at reading the charts to be right 70, 80% of the time, I'm going to make a fortune, which was a foolish mindset. Number one, you don't have to be right that often, depending on your trading style, right? There's all kinds of different trading styles and different strategies you can do. But the style I've landed on after several years is basically swing trading. That's the vast majority of my trading. I play with some other stuff, and I do a little bit of scalping here and there, and I do some day trading, and I do some longer term position trading. But probably 80, if not 90% of my trading is swing trading. But I was so far off, it wasn't even crazy. I thought I had to be a master of reading the charts to be successful. And I got there. I got really good at reading charts. And guess what didn't change? My outcome. Because I hadn't realized yet at that point how critically important the psychology part of trading is. Managing your emotions is hands down. And this might even be successful trading is 10%, 90% psychology. I think that's an understatement. I almost think it's 99% psychology. Whatever number you want to put on it, I don't really care. The reality is what's in your head is way more important than what's on the screen. How you manage your emotions and your mindset is significantly more important than your technical analysis skill, than your deep understanding of the strategy you're utilizing. It is the most critical piece to trading, hands down. So even if you're not a master technician yet, even if you're not a master of your trading strategy, you can still do well in trading if you manage your head properly. Revenge trading, right? It's an emotional response to a significant loss where you're trying to win back the money. And usually you stop doing what you're supposed to do. You get away from your plan if you have a plan. Hopefully you all have a plan by now. If you don't, you need to get one. We'll get into that. But if there's any poker players in here, this is called being on tilt, right? Where you just lose your mind and you start doing stupid stuff. And what you've got to make sure you recognize, and one thing that's important is you've got to learn to recognize where you're at emotionally at all times. When you have trades on, where are you at? If you're on tilt, if you're freaking out, if you're making decisions because you want to get back at the stock or you want to make it back your money, maybe you lost $1,000 or $5,000 or $10,000. Like, I need to get that money back. First of all, you shouldn't be trading with money that you need to pay bills, right? That should be a well-known fact, right? But what happens is, and I wasn't really there when I was younger, but I remember having the mindset like, if I can get this amount of money that I can trade for a living. And at some point, I got to that level and I was like, okay. And then what happened is I started revenge trading because if you're worried about using the money in your account to pay your bills, your emotions are now tied to that in a much more dramatic way than if you say, okay, I can afford to lose this amount and still be okay. I'm not going to risk my a roof over my head or my family's head if I lose this money. If you're in a place where you need the money to pay your bills, you're going to probably be significantly more subject to revenge trading than anything else because, like, I had $100,000 and I need $10,000 a month to live on. I just lost $5,000. I got to get that 5,000 back because I need to get back up to 110,000 so I can take 10,000 off and pay my bills. That's a bad place to be. You will absolutely destroy yourself if you're in that place. The main thing to take away from today is to make sure that you are constantly monitoring where you're at mentally and emotionally, no matter what's going on, right? But there's fear and greed. Greed to me is FOMO. That's all. I don't. Greed is everybody's greedy, right? We all have greed. There's nothing wrong with greed, depending on what you use it for. If you're greedy and you make a bunch of money and you use that money for good purposes, that's not a negative thing, right? If you're greedy and you step on people, you stab people in the back, or you're breaking the law to get your money, that's greed and that's bad. But greed in the context of trading, we're usually talking about FOMO, right? Fear of missing out, right? But it will keep you in losing trades longer, which is the next one. The pain of the psychological pain of loss, which psychologists have determined is twice as powerful as the pleasure of an equal gain. That right there is why um, you cut your winners short and you let your losers run because you don't want to take a loss because that is significantly. You get up a little tiny bit, you're up 1,000, 2,000, 500, 5 grand, whatever number is. Woo, and you take your profit, you're like, woo, and you feel good. You feel great, right? It's like awesome. But then you have one go against you. And the feeling of having to take a loss and saying, I was wrong is literally emotionally, psychologically twice as painful. It causes you more emotional pain to do that than if you made the same amount of money. So you're up $1,000, you're like, woo, you take the profit, woo, you get down $1,000 and you're freaking out. And you don't want to take the loss. So you hang on and wait. And then it gets worse, and then it gets worse, and then it gets worse, right? Bad place to be. The key is to flipping your emotions to the opposite place. The question is, how do you do that? And we'll get there in a minute. Well, a few minutes. How do you go from hanging on to your losses? And there is, what is that? I got to read. If you haven't read this, Thinking Fast and Slow by Daniel Kahneman, that's awesome. This talks about the loss, and they've done all these studies, right? And that's how they know this. And they literally measured it where it's twice as powerful. Is you give people an option. You say you can take risk. I can't remember exactly how to put this. I should dig through it and figure it out so I can enunciate it properly, but I'm not. Um, so I can give you two options where you have a 50% chance of a gain or a 100% chance of a loss or vice versa. Again, I don't remember how it goes exactly, but it's essentially the outcome will be the same. But what people will do is they will, when it comes to the risk side, so here's the potential profit, here's the potential loss, and the outcomes are really the same. It's the way it's framed. It's like, okay, if you're willing to take the loss more than you're willing to take the gain in certain situations. And then they change the numbers around. Again, I can't remember it. I have to put it down on paper and to be able to, like I said, to be able to explain it well. But get the book if you're mildly interested in human psychology and succeeding in trading long term. It's a book I think you absolutely have to read. Get the audiobook. I've got the audiobook too. You can do either one of them. But what you've got to do is learn to flip the script. However you do that. One of the things to combat revenge trading is making sure that you have a clear, non-negotiable plan. right? Um, at least Daniel Kahneman, Kahneman. You see that? Hopefully, he passed away 2 or 3 years ago. I heard. But yeah, it's a really, really, it's very deep. So if you don't like deep stuff, then it's a very deep book. It's not an easy read necessarily, but at the same time, it is it's very, very good on the psychological side of things. Yeah, Roman, that's what I'm feeling right now. I'm like, ah, that's something I've been I'm pretty much I wouldn't call myself a perma bear, but I've been bearish for a while, even though the market has been rallying. I mean, over the last couple of years, but it's starting to show some cracks. The cracks that I've been talking about are starting to show up, and the last week has been rather spectacular. If you know what I mean, you know what side I'm on. But today it's like giving back some gains, but that's all right. I'm up. I mean, I was up so much that it didn't. I'm willing to give back a little bit. I don't like to. I look at today and I'm like, turn back over and tank, would you? But I banked enough that I'm totally cool with where I'm at. So, excuse me. Sorry about the cough. It's annoying. Um, but one thing you'll notice there in the middle, in the middle of that right there, non-negotiable rules for what to do after a significant loss or a win. Now, some of you are like, why? If I'm winning, why would I quit? Because even though we're talking about revenge trading and the desire to get back what you lost, there is, if you flip that coin over, the other side of that is that if you have a monster win, if you hit a home run or a grand slam, you are on cloud nine, right? And then it's very easy to let our mind drift into this arena that says, "Oh, this is easy. I'm going to do that and I'm going to do that again." Going back to baseball again, what happens after a hitter hits a home run? Do they come back and hit a home run again on the next at bat? It's extremely rare. I actually ran that through Grok. I was like, "What? How often do players hit back-to-back home runs in the same game? Like home run, back to back." And it was minuscule, like fractions of a percent. And trading's no different. Just because you hit a home run doesn't mean you're going to hit a home run on the next trade. In fact, in my opinion, it dramatically increases the chances of you taking a loss, possibly a big loss on the next trade, because we naturally get kind of lazy and just like, I got this figured out. Can tell you the number of times I've had that thought go through my mind, where you're kind of you're just chopping around, you're doing this, you're making a little bit, you're giving a little bit back, you're making a little bit, you're making a little bit, and then you have this huge winning streak. Oh, I got this figured out, man. Order the Benz, right? And then you slack off and you stop being disciplined and sticking to your trading plan because you think you figured it out, and you don't need to stick there. Yeah. Brenda says every day I'm brought back down to earth. It's one thing I've said for a long time. If you will humble yourself, the market won't have to. If you start to think that you got it figured out, and the market will absolutely smack you upside the side of the head and teach you a lesson real quick. Because it's a 50-50 shot. Every single trade is a 50-50 shot. Every single trade. I don't care how good you are at getting your analysis. I don't care what the chart says. I don't care how you feel. I don't care about any of that. None of that matters. Trading is a combination of skill and luck. The skill comes in analyzing things, seeing what might come next, and then getting in the way of that potential move. But on top of that, also managing as the trade is moving. So it's a combination. It's not 100% luck. It's not 100% skill. Again, going back to baseball, just like batting, you develop a skill and you have the skill of recognizing, looking at the game. It's this inning, it's this score. Here's who the pitcher. This is the kind of pitches he throws. Here's the count. Here's what kind of pitch is likely to come next, but you prepared for anything to happen and then adapt on the fly. And you react with your training and boom, make a decision, swing or don't. And then, you know, hitting it, making contact is number one. And then getting it in the field of play. That's a lot of that's just luck. It's a combination. And we've got to remember that. But the key is that if you have a big win, it's not a bad idea to step back. And I'll never forget this. We were in Vegas, it's probably 15 years ago. We were at a live event teaching, and I was up on stage and I said something about this. It's the first time I remember mentioning it in any kind of training class. I said, if you have, because what do we do when we lose, right? If you have the kind of standard rule that everybody throws out there is if you have three losses in a row, go back to paper. So I said, well, what if you have three winners in a row? Shouldn't you go back to paper then too? Everybody looked at me like, are you crazy? Like, why would you do that? If you have winners, just keep going. And Mary, she said, I have 25 winners in a row. Why would I have stopped trading? I would have missed out on all those profits. I said, that's awesome. And a minute or two later, she did raise her hand. She said, well, in the interest of transparency, I probably should say that the next trade or one or two trades, I gave back all my profits. I said, hey, I appreciate that. Excuse me. So you've got the formula backwards then. You're letting your losers run and you're cutting your winners short, which is hard to do, right? Because you want to bank your profits as quickly as possible. You don't want to leave it out there at risk. Um, Fear and greed. I mean, we all know this, right? Market is a reflection of collective human emotion, which is why it's so important that we focus on managing our emotions because that's what trading is. Everybody in the market that's trading, except for the algorithms, right? Which actually accounts for about 70% of it. But even those, they're just math based. They're just data driven. There's no emotion to them. They're just reacting to what's happening mathematically, right? But the other 20 or 30% that are making decisions on a day-to-day basis, whether to enter or exit a trade, they're driven by emotion. That's why you have panic selling. The last couple of days, I'm sure there was plenty of people that were freaking out. Ah! If you're long, if you're bullish, you're getting hammered the last 2 or 3 days and panicking. And now today they're probably like, I should have stayed in. Right? So then they get back in. Maybe they do, maybe they don't. It just depends on where you're at, right? But greed causes you to chase the hot stocks. Over leveraging. Notice that. That's a big one, especially considering that we're trading options, right? Options are a form of leverage. And if you put too much, if you don't understand that, you don't know that that's the tool you're working with, then you could get hammered really, really bad. You can make a lot too, right? It's a double-edged sword. Leverage is a double-edged sword. You make a lot really fast, but you flip that coin over and guess what? You can lose a lot really fast too, which is why so many people are scared of options. Like, oh, well, it's leverage like any other kind of leverage. Buying a house, if you buy a house, that's leverage. If you take a loan, right? If you put 20% down and the bank loans you 80% of the house value, that's a form of leverage too. If the value of your house drops by 20%, then guess what? You owe the bank the same amount you could sell it for, not including all the fees and stuff that come with it. I know in Washington, it's about 10% to sell a house here. So any kind of leverage can be dangerous. So you have to first understand the leverage you're using and then make sure you use it wisely. Options, generally speaking, you get about a 10-to-1 leverage with options, right? So every 1% the stock moves, you get about a 10% move in the option. Now, that's just a general kind of standardized rule that I've seen over the last 25, 26 years. So you don't need, that's the thing. Some people get in, you bring 20, 50, $100,000 to the market. If you bring 100 grand to trading, you drop $20,000 into an option trade. In my opinion, you're freaking nuts. Because number one, if something happens and news comes out, which then gaps against you, you just lost 20% of your account. I have a flat 10% rule, and it all depends on the size of your account, right? The bigger your account, the smaller the percentage should be. And actually, on a $100,000 account, I'd probably go closer to 5%. But like, here's the maximum I'm going to put into, especially if you're using leverage, that is. If you're buying a stock, something solid, 20% is not that big of a deal. But if you're using leverage, it should be a lot smaller percentage. Because the reality is, if you wind up being right and it moves in your direction, you're going to kill it. You're still going to make a ton. And if it goes against you, it doesn't hurt as bad if you're using a smaller percentage. Right? Excuse me. Keep thinking it's almost gone. That's kind of appropriate, huh? Shift your mindset, right? Gambling to business. Now, I take a little exception with this. I did bring up poker earlier, which don't tell on me. Gambling, business is business, right? And the casino is treat trading, as it says, treat it like a business with a plan. It's like any other business, like I've been talking about here. Now, the casino, if you go in and play slots, that's gambling. You play roulette, gambling. There are a couple of games in the casino, and a lot of them aren't even in the casino. They're just card rooms, right? Poker, you're not playing against the house, for one. Blackjack is a statistical game. If you have the right strategy and you understand when to hit, when to stay, you actually can have an advantage over the house. So if you treat blackjack or poker like a business, that's different than playing slots or so I'm differentiating because a lot of people think casino and that's just gambling. And that's an either or mindset in my world. There's a both and. You can go to the casino and you can both be in the casino and be playing a game where you have a statistical advantage. I know in blackjack, I have a 1.5% advantage over the house. Over the long term, I will win a buck and a half for every $100 I play. Because I know statistically, from a mathematical standpoint, when to hit, when to stay, and I know how to count cards, which is actually really simple. So I know a lot of people don't like talking about trading as the casino, but there's not a whole lot of, it's not, trading's not gambling like going and throwing money in a slot machine is. Trading's more like playing blackjack or playing poker, which are skill games that you can have an advantage over the house. So I differentiate the two. And I've gotten some flack because people say, "Oh, you're treating like gambling." It's not, trading's not gambling. It is gambling if you don't know what you're doing. It's gambling if you don't have a plan. Anything's gambling. I mean, you hand a set of car keys to a 10-year-old that's never been behind the wheel of a car, you're gambling with a kid's life. I mean, that's not going to turn out well. Anything in life can be gambling. The question is, do you know what you're doing? Do you know how to play the game, if you will? So I don't look at things just on surface level. I usually dig deeper, peel the onion back. But the key is to that is hilarious, Roman. I'm sorry, that is hilarious, especially right now. He says it's gambling when you became a crypto trader. Well, you know what? I'm going to pick that apart a little bit too, because I do. I like to peel the onion back. Okay, I don't just look at the surface level thing. Oh, well, trading crypto is okay. Considering crypto like a Bitcoin an asset, I think is nuts. If you're a hodler, right? If you're just buying Bitcoin because you think it's going to go to $1 million or $10 million a coin, you think you're going to get rich off of it. That's gambling, in my opinion. Trading it on a short-term basis, I'm kicking myself for not shorting it actually, because I can't say I knew this was coming, but I highly suspected. I figured the odds were extremely good that the drop in crypto was going to come eventually, and it's probably going to accelerate and get worse. Eventually, in my opinion, it's going to go away, at least in the form that it's in now. But that's just my opinion. Other people believe it's the savior. It's like, no, it's not Jesus. It is just whatever. But that is funny though. I kind of laugh about it. So yeah, I'm still tempted. I do have it on my list here. I've got a list of all the markets and futures. I have Bitcoin on there just because I'm curious to see what it's doing. Um, but yeah, speaking of peeling the onion, that's when it comes to crypto. I ask this one thing. I lay this out for all these goofballs that these cultists that get on and say, "Ah, it's this and that." And like, what does it do? What real world use does it have? Because really, when you break life down to its most basic, you got food, clothing, and shelter. And if you have something that doesn't fit into one of those boxes, it's useless. Doesn't mean anything. And you could take all the other stuff, real estate, houses, lumber, all the stuff that's made in a house and a car, and things that we actually use, they actually have uses. Bitcoin has no actual real world use. You can't put it in any one of those three boxes. Could be a good trading vehicle. It is because it's super volatile, but that's the only real use it has is to get in and get out and make some profit if you time it right. Other than that, like I said, that's just me. But I like to break things down and keep them simple because that's life's not really that complicated. It's food, clothing, and shelter. That's really all it comes down to. All the other junk we have swirling around us is just superficial stuff. So, um, but number two bullet point there: focus on the process, not the outcome. Create a solid plan that works for you based on your trading style. Okay, here's how I'm going to trade. Here's whether you're going to do swing trading or day trading or scalping or long-term trading, whether you're doing spreads or figure out what works for you and your personality, your risk tolerance, the amount of capital you're working with. There's so many variables. It's very personalized. But whatever you land on, wherever you get to, and you kind of have to do trial and error. You have to test out different types and see how it works and see how you respond. That's where managing and recognizing and paying attention to your emotions, right? The old adage, know thyself. That's where it comes in critically important is you've got to recognize, I did this trade and it just freaked me out. If you're trying to day trade or trying to scout because it's so short term in nature, it's like, and you're freaking out, that may not be your style. You might need something that's, a week or two out, maybe even a month or two out. Trade on a longer term basis. So you got to figure out where you're at mentally and emotionally. Excuse me. But focus on not necessarily how each trade comes out, but what's the process to get there? And then can you get consistency? Because the one thing you want is consistency. Over 25, 26 years of doing this and being in this business and teaching others and watching others teach and meeting literally thousands of people from all over the country and hearing the things that they're doing and what they're got. One guy, I took 30 grand, turned it into 300,000 in like 2 months. Awesome. Cool. I love hearing those stories. Next time I saw him a year or two later, he was pawning off his like, well, my buddy did this trade on this, and he put $10,000 into it. Now it's only worth $500. It's like, what should you do? Should you just get out or just hang on and hope? That's really your trade, right? Yeah. Pawning off on his buddy, like my buddy did this trade. No, he didn't. You did. Okay? It's okay. We're all human. We make mistakes. I've made plenty of stupid trades like that. Um, so don't feel bad. You're not alone. I don't know any trader that hasn't done it. In fact, I don't know any trader that hasn't blown up an account at least once or twice. And if you read books about people that have traded their whole lives, they'll tell you people blow up their accounts. It's part of the learning process. It sucks. It's not fun. I've done it a couple of times, but it's a good lesson. And if you don't take a lesson from it, then you're going to quit. And the only lesson to take is that number one, trading is very difficult. You're going to have a lot of rough patches. And the key is to just keep going. Just don't quit. The only way you fail in this business, as far as I'm concerned, is if you quit. And the reality is, if you get to the pinnacle, right? Just like, again, going back to baseball, like I always do, you work your tail off as a kid all your life, going through college. Now you don't have to go pro, but get into college, you work your tail off to make it to the bigs. You're eating ramen noodles that whole time. And then when you make it to the bigs, guess what you're doing? Now you're eating steak. So the key to succeeding long term in trading is keeping that mindset there and recognizing that, yeah, there's going to be a lot of bumps and bruises. You're going to take a lot of flack. There's going to be a lot of, you got to overcome those mental hurdles. Because once you get to the pinnacle of your career, guess what? The payoff has the potential to be massive. So keep that in mind. But embracing uncertainty, right? Losses are part of the business. That is one. I took one yet or day before yesterday, and then of course yesterday it tanked. I was like, it's a bearish trade. It moved, popped up, which relative to the rest of the market was super strong. And I'm like, this thing really could pop tomorrow. And then it took off to the downside yesterday. I'm like, and I just barely went past my stop. But I'm looking at it going, it wasn't a huge trade. I think I was only down 200 or 300 bucks. So it wasn't a massive loss. It wasn't even a big loss. It was relatively small. And that's why I did it. I'm just like, 200 or 300 bucks is, in the big scheme of things, is nothing. I just get out of it. And if it comes back, it gives me an opportunity to get in, then I'll jump back in. And if it tanks in one day and I miss out on thousands of dollars of profit, I'm going to be mad. But that's all right. I'd rather miss out on a huge profit than get hammered with a huge loss. Right? Um, Trading plan. It's a non-negotiable rule book, right? You define your entry exit before you enter the trade. More important than that, in my opinion, is having your plan for what you're going to be doing during the trade. This is the one question that I think you need to absolutely pound into your mind is right there. Am I comfortable with the risk in this trade? You should ask that before you pull the trigger, and you should be constantly asking that while you're in the trade. If you look at it, and there you go, Brenda. Um, if you're looking at the trade going, okay, I'm going to put $5,000 into this trade, and if it goes against me, barring any kind of gap, right, then I might lose $1,000. Am I comfortable giving the market $1,000 to find out if I can make three? If you can answer that yes, pull the trigger. If the answer is no, I don't want to give the market $1,000. I'm only comfortable with 500. All right, well then cut the position size in half. You should always be in a place where mentally and emotionally you are comfortable with the amount of risk you are taking. Now, let's say you pull the trigger on that trade, you put that $5,000 in there, and it goes up, and you're up a couple thousand. It's at 7, your target's at 10. You're sitting there with $7,000, and that's what it's worth. You got $2,000 of profit. Now, some of you are like, I'm taking it. Just gonna take the profit. I don't care about my target. Whoops. Dang cats. Well, target doesn't matter. I just want to bank my $2,000 profit. And so you get out, which is fine. It's not like it's a bad thing, but at the same time, guess what happens? Then it keeps going. It goes to your target. You would have made $5,000, and now you're cranky and mad. Now you're getting into that emotional loop. So again, going back to the question, you're in this trade. You put 5,000 in. You're now sitting at 7. You got $2,000 profit. The question should be in your mind: am I comfortable risking the entire $7,000? Am I comfortable risking the $2,000 of profit? And if the answer is no, then adjust the trade accordingly. You say, well, I don't want to. Cheese ball. Could have waited 20 minutes. I'll be done. So I don't want to risk the whole $2,000 of profit. So how much are you comfortable risking? Then you have to answer that question. Well, I don't want to, I'm going to take half off the table. I started with 5,000. If I take 3,500 off the table, now my net cost, if you take what I just put back in the account, is 1,500. So if you paid $5 for those options originally, you've now got, is the math right? Let's see, the cost basis will be $3 then, right? Because you've got $1,500 of net risk from where you started at 5,000, and you got 5 contracts less. That's $3 a contract. So your options are sitting at 7. You just took half the profit off the table. Your cost basis, again, based on your starting point, is $3. So you're not taking a net loss on that trade until it gets below 3. It's got to drop 60% or so before you're taking a net loss on it. Right? It'd have to go down below $1,500 of value from 3,500. So again, the question should be before you pull the trigger on the trade and constantly while you're in the trade, am I comfortable with the risk? in this trade? Am I comfortable with how much I've got on the line? If you answer yes, leave it alone. If the answer is no, adjust it. Adjust it so you can answer that question yes. I think that's the one thing that's really changed my trading, and I'll show you why here in just a minute. But trading journal, that's I've tried this. I mean, as far as like a physical journal or even a digital journal, I've tried this, and all I do every time I have a trade, whether it's a good trade or bad trade, whether it's a winning trade or a losing trade, it depends on how you define those, right? I go through that in patterns in a flash, but um, I can go back and evaluate. And go, okay, is there something what did I do good? What did I do bad? What can I do better on this? And so I just make mental notes. I don't keep I tried that and I just for whatever reason just I couldn't do it. Writing it down physically, I know a lot of people like that. They do that. People love to journal just their emotions and stuff every day and writing it out. It's never worked for me for whatever reason. Do what works for you. Find what works for you and do it. There's no right or wrong answer to how to do this. It's a question of what works for you. Find mindfulness detachment. Find techniques to stay calm and relaxed. Calm, cool, and collected is where you want to be at all times, no matter what the trade's doing. I mean, most of mine right now are going against me right now. I'm like, I'm not really freaking out though, because I already banked a bunch of profit. Most of the positions I have are small now. They're profitable and they're small because I banked a bunch of the risk, which takes me to the next point. Now I can't see, Kitty. There you go, Brandon. Say goodbye. Go fight the other one. Um, so yeah, I mean, I've already banked a lot of profit. I'm not giving a whole lot back. So I don't like giving anything back, but it's the nature of the beast, right? It's just the way it happens. But you can use AI to help with our human biases. Algorithmic trading, if you find you just can't handle the emotions of trading, then either create yourself, if you're a nerd, create an algorithmic trading system. There's some out there on the market that you can buy. You got to be very, very careful. You got to understand enough to understand what it is you're buying. I wouldn't buy one from somebody else. I would create one myself. I'm not a nerd, but I would rather become a nerd and figure out how to do it than to buy one that may or may not be any good. And if you don't understand algorithmic trading and how that works, then I guess I shouldn't have told her to go fight the other one. I don't know if you can all hear that or not, but that was. I have two. I'm a crazy cat lady now. I have two cats. I accidentally got a Maine Coon about 2.5 years ago, and then my neighbor let this other one in last January. I was out of town, and he'll come over and make sure the food and water's still good for the Maine Coon. And he calls me. He's like, "Yeah, there's a little kitten on your porch. It just ran in the house. I can't find it." I'm like, "Yeah, whatever." I thought he was just joking around, but he wasn't. I got home and I was like, "Holy cow, he was serious." And nobody claimed it, so I don't believe his story, but whatever. And she's mean. She's always attacking the Maine Coon. The Maine Coon's really chill. But yeah, if you don't understand algorithmic trading, then that's going to be a challenge. I don't understand it in depth. I know enough to be dangerous. I have been kind of playing with it a little bit lately, just out of curiosity. And AI, you could use AI to actually say, I want to go into Grok or whatever AI tool you like. I want to create a system that does this and this and this, and they will actually write you code for it. I haven't gotten one to actually work yet. Well, I take that back. I had one indicator that I created that worked. So that's the beauty of AI. It's going to make it easier for people like us that aren't nerds to create an algorithmic trading system, but you've got to understand what inputs you need to have. What's algorithmic trading? It's mathematical inputs. You're saying if this happens, okay, if and you can use it for uh, anything. It's basically just data driven. You're saying watch this data. Um, oh, the indicator. Oh, I was trying to figure out if because what I've observed is that silver would move silver and gold, right? I trade gold futures in the morning. Um, and what I was seeing observationally, right, just watching, it looked like silver would move and then gold would follow it. So it's almost like silver kind of led the way and would make its move. And then shortly thereafter, 5, 10, 15 minutes, gold would then move the same direction. And so I went into this is where you're talking about AI as a tool. I went into Grok and I said, and I found some data. There are a couple of online sites that will give you tick data for free. Most of the time, they charge literally tens of thousands of dollars for the data. If you want tons and tons of data, you pay. thousands and thousands for it. Um, but I found there was a site, and Grok found it for me, was where you could get some tick data. So I go get tick data for a whole day, right? It's like 1.2 million bits of data or something like that from every single tick for the trading day for silver and for gold. And then I uploaded those two into Grok and said, tell me if on a 5 minute chart, if silver ticks up before gold does. And if it does, what kind of move are there? And basically just saying, this is what I want to see. And then I had it write me a script for toss that would pop a thing on the screen that would show how many ticks silver had moved before gold did. And so if it did, which sometimes historically silver would sometimes move, and if it moved like 5 or 6 ticks, then gold would follow it. But most of the time, gold led silver. Anyway, so it was kind of fun just to play around and see if I could make it work. Yeah, ticks. Well, a tick is just from one sale to the next, right? I mean, stocks tick too. If you're watching a stock chart move constantly, each tick from one price to the next, each time a trade is triggered, that's a tick. So you can go look at a tick chart on anything. It shows you literally every single transaction that takes place and at what price it took place at. So that's what a tick is. So it's not exclusive to futures, it's everything. Everything that trades on ticks. Um, I'm not sure what you mean by that, Tom. You're talking about the algorithm part? I mean, algorithm is you're just basically saying if this and this, if MACD is crossing the zero line and Stokes is crossing the 20%, then go long. And most of it is automated, right? And you can do a lot of the software and stuff now, and especially with AI stuff coming out, you can do that. You can have it literally trigger your orders automatically. You could create a whole automated system, algorithmic, which says if this happens, this happens. Yeah, I guess that would be contingent trading. If this happens and this happens, then go do this. But it's using what's the word I'm looking for? I don't know. But you're essentially automating the whole process by using just data stuff. There's no emotional, there's no analysis, there's no nothing. You say, here's the math, and you can back test everything now. You can go say if um, if this happens, then how often do this? But that's where it gets tricky. It's very scientific, and there's a lot of people out there back testing stuff. They say, I back tested this, but if you don't back test properly, you get bad results. AI is not some savior. It's not something. It all depends on the input. AI is awesome, but if you don't input the right information, if you don't ask it for the right thing or give it the right data, it means nothing. And data can be manipulated very easily. So if you go back and backtest on, a bullish strategy from, March of 2009 up to say 2015, you go backtest in that period of time when we were on a big bull run, then what do you think your results are going to be? You're going to have 90% winners. Woo! Look at my system is spectacular. Whereas if you go back to say 2005 to 2015, now you've got a big crash in there. Now you've got a more realistic data because, hey, you've included this period of time that includes also a very massive crash. So you've got to test on the right information. Otherwise, you've got a biased system. It's very easy to get caught up having biased automated systems. Algorithmic trading systems can be very, very biased based on how you test them and who's doing it. Not necessarily who's doing it, but what they're testing on. So it's got to be done very, very carefully. You can't just go throw it together. That's why AI is like right now, it's not good enough to really create something, but you have to be well aware that if you're trying to create an algorithmic system, it's a lot more than it seems like. And AI has simplified it to a degree, but you still have to know what you're doing. AI is just a tool. It's like a hammer, right? If you don't know how to use a hammer, it's not going to be much use to you. You got to know how to use it. You got to have the skill set to use it, right? Watch out for bull traps and bear traps. I just realized we have 5 minutes left. Um, oh, I got you. Okay. Yeah, I would argue that it's both. It's very mathematical, but it's also very rules based. It's I mean, math wise, it's actually super intense. depending on how deep you're getting into it. And I've dug into some deep stuff lately, and it was like, whoa. I never took calculus seriously because I'm like, when am I ever going to use this in my life? Like now we know. But still, I mean, I wouldn't remember it. Even if I took it seriously back in high school, I wouldn't remember it today. Um, the emotional bullet point number two, the emotional journey of the undisciplined trader is not much different than the disciplined trader. Because a disciplined trader that is consistent and making profits consistently will also get cranky when you leave money on the table, right? An undisciplined trader loses money, and they're constantly like beating themselves up because they lost or they did this, they made a mistake or this or that. The disciplined trader is following a plan and will get more cranky about leaving money on the table or missing trades because you were disciplined enough to stick to your plan and say, this is not a setup for me, so I'm not going to pull the trigger. And then because you didn't, even though the analysis was maybe good, but it wasn't an ideal setup, so you didn't pull the trigger and you missed out on a huge trade, which I've done, which is frustrating. It happens to me almost on a daily basis, actually. But you've got to remind yourself when you get in that situation. Actually, I missed that massive gold drop the other day. I was in it just before it, about 15 minutes after I got stopped out for the second or third time, is when it started to just fall off the cliff. And I'm like, I missed that whole monster move, which I would have caught a big chunk of it. So it was frustrating, aggravating, but I also sat there and reminded myself mentally, okay, I'm sticking to my plan. I'm not going to chase this thing. I had to remind myself that I was following my plan and I stayed disciplined and stuck with it, even though I missed out on a huge opportunity. And then I had to flip the switch in my mind and go, okay, where might there be an opportunity after this fall is over? Is there going to be an indication that maybe I can catch a pop to the upside? Because when things collapse like that, guess what they do? Just like today in the market, right? We're having a big bounce back, which is exactly what I did. I missed that huge move on gold, but when it finally started to give an indication that it was bottoming, it was probably going to bounce back, I jumped on and rode it and actually did well because I kept myself mentally and emotionally in the right spot. I reminded myself that I was sticking to my plan, adjusted the plan, go, okay, now, even though I usually trade like this, there is an opportunity here for a mean reversion trade. In other words, it's probably going to bounce back. And guess what? Everybody that just shorted in that whole drop, guess what they're going to do? They're going to come in and cover those shorts. And the bounces back from those big falls is often very, very violent and intense. Not much different than what we're seeing in the market today, especially with certain stocks. When we are in a bear market and things are dropping, the short covering creates these volatile, violent swings back to the upside. Whether or not we're not officially in a bear market, obviously, but you can see today with the big upside move after a big three days of down, or at least in the Nasdaq and the SPX, a big snapback like this is no surprise. Hence the reason I banked a lot of my profits. But finding the balance is the challenge. And the key there is finding the solutions that work for you. And I'm going to wrap up right here. So if you have any questions or anything, just drop them in there right now. These are two things that have worked for me. And it took me a long time to figure out, especially the risk reward. But scaling is another thing. Those two things right there have dramatically changed mentally and emotionally how I trade. Number one, risk reward, right? Most of my trading is swing trades. I'd say 80%, maybe 90%, probably 80%. I do have some longer term positions. I'm usually looking for if you're going to trend trade over a longer period of time, you want a higher risk reward, maybe even a 5 or 6 to 1, even a 10 to 1, because you've got to you're going to have bigger drawdowns, right? If you're looking to capture a big long term 1, 2, 3, 5 year trend, and you're buying a stock at $20 and you're expected to go to 200 over the next several years because you think it's going to grow, which is not my style, but there are some that I'm looking at going in a year. I think we could be at this spot here. So I may take on a longer term position. I might buy Elite. If that's the case, I want a bigger risk reward because you have a bigger range for your stop loss because you've got to endure those bigger swings. But most of mine are, 1 to 5 days, maybe 2 or 3 weeks. So I'm looking for 3 to 1. And what you'll recognize if you haven't seen the math on it is if you use a 3 to 1 risk reward ratio, You only have to be right a little bit more than 25% of the time in the long term to come out ahead. Now, usually when I say that, people look at me all cross-eyed like, that's crazy. But just simple math. Think about it. You got $3 of upside. So you pull the trigger on a trade, you got $3 of profit potential, and you have $1 of risk. If you do four trades and three of them go against you, and you lose $1 on each of those, and one of them goes in your favor, you've done four trades, you lost $3, $1 at a time. One winner was $3 winner, you're break even. You made $3, you lost $3. You're break even. You had only one out of four trades did what you expected. That's 25%. So your accuracy rate, your being right rate, whatever you want to call it, was 25%, yet you're break even. So if you can get to the 27, 28, 30% range, long term, you should come out ahead, right? That's the way the math works. I've done it many times here, showing it. There's a little spreadsheet and flipping the coins and doing that. It's a lot of fun, actually. I think it is. Because it opens a lot of people's eyes. They go, wait a minute, I thought I had to be right more than 50% of the time. No, you don't. Let your winners run, cut your losers short. If you have a $5 winner and you have three $1 losers, guess where you're at? You're up $2 and you're only 25%. You don't have to kill it on every trade. You don't have to be better than 50%. And when I realized that, I'm like, why am I freaking out? And what it allowed me to do is, okay, here I have, and I experienced this like a vast difference because I had these trades. I thought I was a good trader at the time, and I was okay, but I had these trades where now that I look back on it, I just call it winging it. Back then, I didn't think I was winging it, but I didn't have a 3-to-1 risk reward. I didn't have a plan in place that was really that solid. I like, okay, here's my stop if I decide to follow it, and then I'll just let it do its thing, whatever. Then this hit me where I'm like, wait a minute, why am I not using this? I learned risk reward early on, what it was, basically superficially. Now all of a sudden I'm realizing that I don't have to be right that often. And so I had a few more trades. I think I had four trades on. I had a few other trades that were sitting there too that had been on for a little bit. And I created a plan on these. Okay, I'm going to do this. I'm going to follow these plans. 3-to-1 risk reward. I got this. Here's my target. Here's my risk. And what was funny is the contrast between the two. I was nervous and anxious about these ones. I'm kind of like, you know how your knees twitching every day, your hand palms are sweating. I wasn't like that, but um, and then I had these other trades over here that in my mind I'm going, I don't really care what happens to any of those. As long as one of them goes in my favor, I'm going to be okay. Because I'm looking at the numbers going, okay, if this one works out and that one, those three fail, or if this one works out, those three fail, and they hit the stop, I'm going to be okay. I might be underwater a little bit, right? If you have a really volatile stock that you take a loss on, and then you have the other three are maybe not so volatile. So, you know, the volatility obviously comes into play. But when you're talking long term, I'm looking at this going, I'm calm, cool, and collected about these trades I have over here. These other trades where I don't have a risk reward plan in place, I'm like, I'm nervous about them. That's when I realized that one simple little, just adding the risk reward thing is gets me to a calm, cool, collected place where I'm just relaxed. I'm not worried about the trades. They're going to do what they do. As long as one or two of them work out, I'm good. Position trade, yeah, a little bit longer term. Usually, I mean, a month, 1 to say 12 months. It depends on whose definition you talk to, right? Because everybody defines things a little differently. Swing trades are generally considered, you know, one day to 7 days. Again, depends on who you talk to. Some people say 1 day to a month. But yeah, so a little bit longer term trade. I'm not doing anything 5 or 10 years out, but 1 or 2 years possibly. I've got a couple of small stock positions that have potential to explode. And if I do that, you just throw a little bit of money at it on the side, just leave it there and let it go and see what happens. And if they do, great. If they don't, no big deal. So that's what I would consider to be a position trade. So, but if you're scalping, you might even have 1-to-1 on scalps or day trades. The other thing, real quick, is we're not gonna have time for charge point. I got way deeper into this than I expected, but scaling. Scaling is another thing that will dramatically, if you employ risk reward and scaling, you'll watch your trading change dramatically. Your consistency will become better, which is my goal. I'm not so worried about hitting home runs and stuff like that. I'm good getting consistent singles. And scaling is, well, number one, it's going back to the question, are you comfortable with the risk you're having in this trade? but managing that position size to fit where you're at emotionally. But the big thing is to manage your emotions if the trade is moving in your favor. Here's generally speaking how it works out for me. If I get into a trade, I'm usually getting stopped out in 1 to 3 days. Typically, it's like the next day. So I'm getting in today or maybe 3 days later. Sometimes it's a week, but usually it's about 2 or 3 days, maybe four. If it moves in my favor, sometimes it will do that usually in the same time frame, but now it's moving in my favor, so I want to give it room to breathe. But I also don't want to give back my profits. I want to bank those profits. So what I will do is I will scale out as it's moving in my favor. Right? I'll give you an example actually. We'll, um, this one, I don't know. Okay, I'm glad I'm out of this now. And I mean, this drop we have is just beautiful, right? You got a head and shoulders. Here's snow. Um, so it broke the neckline there, right? This is the beauty of patterns. That's why I love them. Got a head and shoulders. It's not, it's pretty nice. It's not spectacular, but it's nice. Breaks the neckline. Boom, it dances around here for a little bit. And I nibbled on this a little bit. I want to say back in here. I think it was like the 20th or 21st, somewhere in here. It was just kind of chopping sideways. Excuse me. I was like, all right. And I bought some longer term, I think 4 to 6 months out of the money. When I'm trading, especially the big volatile stocks, what I love to do to get more leverage, which again is a double-edged sword, it works out spectacular. What I'm about to show you, right, is especially when I have a pattern like this that has a potential for a big move, is I'll go and find the target, which in this case was about 150, and I'll go longer term, usually at least 4 to 6, if not more months, just in case it takes longer than expected. Um, and I will pick up an option that's at the money, right? Like in this case, the 150s for 4 to 6 or 7 or 8 months out. Because what you get then is the delta flip. If it moves like this, you get a delta flip. You start out with a delta that's maybe 10 or 20, and by the time if it gets to the target, your delta's at 50. And the most expensive options are which ones? The at the money options, right? So if you can buy them, the out of the money options are cheap. The in the money are, from a time value perspective, are also cheap. You're just paying a lot for the intrinsic value. But if I can pick up a bigger position, if I can go out of the money like this and it moves like this, I can buy a lot more out of the money options when they're $3.75 versus buying a $15 or $20 one that's in the money, which I think is about, because I looked at this too, just out of curiosity. I think they were $20 or $22 for the 225s or something like that, or 220s. The Delta that had about a 65. It's like, you know what? I can get a lot more at 375 than I can for $20. That gives me more leverage. So if it moves big, I kill it. Which is, I mean, I didn't know this drop was coming. I expected it to drop. I didn't think it was going to happen this fast. That was just a bonus that it happened very quickly. And I almost stopped out that day, but I did. I decided to wait till the close, and it was like, okay. And I was happy I did. But I literally paid $3.75 for these. I put an order out for a third of it at $5. Well, if it drops down and hits it, then I'll get a third of my risk out of the way. I'll bank a little bit of profit, which reduces my risk even more. Right. So now on the other 2/3 of the position, I don't have as much out there. And I think it was this day right here where it hit the $5. So I'm like, all right, cool. And it kept tanking, and now I'm like, should have held on, right? It's always the woulda, shoulda, coulda. But I'm like, you know what? If it hits 750, that'd be a double. So I'm gonna put the other third of the position, one more third of it, I'm gonna put out at 750. I just threw an order out there. I didn't expect it to hit, and it was, I don't remember what day it was. I think it was this day, but it was one of these days. It came in. I think it was that day right there actually, where it just fell off a cliff, and I'm like, all right, maybe I should move it. I'm like, nah, just leave it. I still got some there. And here's the beauty of scaling. Even though looking back on this, I wish I would have just held on. You're going to have situations where you do that, you hold on, and it goes the opposite way because it's a 50-50 shot, right? This move this quick was just pure luck on my part. My analysis was good. The expectation was there, and it just happened to move very quick, very fast. So within a few days, this thing, and it hit 750. The beauty is that I just banked. I now have all my initial capital back and a profit. Because let's see, what was it? I don't even remember. I've gotten double on a third of the position, and I've got a 30 or 40% profit on the other third of the position. So I have all my money back and a small profit. Now, whatever happens with the other one, I don't really care. I mean, obviously, I want it to move. And I put an order out there for, I think, 25 bucks, which was down to like 125 or something. Well, yeah, it would have been 125 because that's the intrinsic value. Maybe this thing will keep tanking. Then this morning it pops up and it pulls back a little bit, and I'm like, I ended up just like, you know what? I'm going to take the profit. I've got exposure on other tech software names, so I'm not worried about this one. I'm going to take the profit on this one. I think I sold it for 11.90 if I remember right. It hit this morning. I just threw it in. I just changed my order to a market order. So 375 to 11, whatever it was, it came out to I don't know, 100, 150% somewhere in there overall net net. Um, which again it's a combination of skill and luck. This fast of a move, that quick to have that happen. But that's one of the reasons I scale. Looking back, if I'd have known it was going to drop like that, I wish I'd have just held on to all of it because I sold a third of it at $5. I could have gotten more than double in that. God, look at how much money I left on the table. But the beauty is that I wasn't worried, especially once that second, third hit at 750. Now I've got all my money back. I've got all my initial risk back and then some. Now, whatever happens with it, I could have sat on it longer. And I kind of vacillated back and forth this morning in my mind. I'm like, do I want to get out of this or not? Do I want to bank the profit? Because it could very easily snap back big and run all the way back to 200 and all my profit's gone. And part of it was I already have exposure to other names, so why keep this? Let's just bank the profit on this, put it in cash, wait for an opportunity. If it runs back to 200, then maybe I'll get back in it. Maybe I'll reload it. That's the beauty of scaling. It allows you to do that. And same thing with, I mean, I don't know if it's, yeah, I think it's on this list. Now this one's making me cranky today. Well, and here's the beauty of this. I don't know where I'm at net. Well, I'm down a little bit. So the beauty of this is, so here's the trading plan, right? We got a little miniature Head and Shoulders, just kind of like, But it broke down, got into this. I had an order out for part of it at like a 30 or 40% gain. It hit this day and continued to drop. And I was like, cool. Or maybe it hit one of these days. I don't remember where it was. But I'll put an order for part of it, a quarter or third, depending on what it is, up above the market. And if it hits, great. If it keeps tanking, then cool. That's even more money. That's the beauty of scaling is it allows you to continue to be greedy with less fear. Because you've banked some profits, you got risk off the table. And now if it bounces back like this did, then I'm looking at this. I'm going, well, I'm still confident in the bearish position. So I reloaded somewhere on that day when it was up around the one. I think it was right at the close when it had sold off during the day. And I'm like, okay. Um, so I re-entered the trade. I reloaded that third of a position and then put an order below it, and it ended up hitting yesterday. So I've been in and out of this twice. I still have a small position, but I'm not freaking out right now. Even though it's above my stop, I'm going to wait till the end of the day, and if it pulls back down here, then I'm going to hang on to it. If not, then I'll probably exit, and I'm down like it looks 80 bucks. It says 90 bucks on the net position, which stinks. I don't like losing, but I mean that's a big move for the day. And considering I've already taken enough profit out of it that I'm only upside down 90 bucks, I would be upside down probably 500, 1,000, 1,500 if I wouldn't have done it that way. Again, it's just one of those, it's a matter of figuring out what works for you to keep your mindset in a calm, cool, collected place and be able to make solid decisions without freaking out and panicking. That's the ultimate goal. Once you get to that spot, when you can trade in a calm, cool, collected fashion, you're not freaking out all the time, then you've arrived. Then your trading will change. And that should be your goal to get there, to that calm, cool, collected state. So, all right, I know. Holy cow. Sorry, Andrew. All right, I got to shut up. Other things going on, and I'm way over time now. So, um, oh, yeah, that's a data thing, Brenda, that's going to have to be done by whatever data provider you're using. I got the same thing. It's annoying, I know. But she's asking about the glitches in data. They have to clean up their data. That's the only way to get it done. I mean, you don't have any control over it as far as I know. So, all right. Well, the kitty wanted to say goodbye. Throw her off here. So, thanks for hanging out, having some fun, and we will see you all down the road. Y'all take care. Have a great weekend. God bless. Bye bye.